Hello, everybody. Welcome to Gesmer Updegrove's M&A Growth Strategy Roundtable discussion. My name is John Cohan. I'm a corporate partner here at Gesmer Updegrove, practicing in the M&A, venture capital, raising, and outside general counsel space. With me today, I have a very talented group of individuals who are in the service provider space, starting with David Walsh, also Rich Weiner, Mark Diebus, and Tony Buschetto. I'm going to let them each introduce themselves, and I'm going to start with David.
Great, thanks, John. Hi, everybody. I'm David Walsh. I'm an investment banker at Oberon Securities. We're an investment bank based in New York. I'm here in Boston, and we serve clients that are typically owner-led businesses looking to transact, sell their business, typically over $3 million in EBITDA, and doing transactions anywhere from $15 million to $200 million.
Great. Mark?
Thanks, John. I'm Mark Diebus. I am a commercial cash flow lender at Middlesex Savings Bank. My customers typically are manufacturers, transportation, logistics, industrials with 10 to $100 million in revenue and EBITDA of approximately $2 to $15 million.
Tony.
Thanks, John. Tony Buschetto from firm Brook Trail Associates. We have a CFO advisory practice. We work with privately held business owners, similar industries, construction, manufacturing, similar size and scale to the other people on the panel. Primarily working with businesses that they've grown and they want to continue to grow and scale, but they haven't professionalized their accounting department, especially when they're trying to get ready for a potential transaction and they don't have a team that can support them through that deal.
Great. Rich?
Thank you. Rich Weiner. I'm a commercial tax partner at AAF CPAs. We're a Massachusetts-based firm. I'm a commercial tax partner in our transaction advisory practice. We're industry agnostic, but with a focus of what you see in eastern and southern New England. Typical deal size in our sell side practice runs from $20 to $80 million, but we work with a number of transactions that are larger and some that are smaller.
So I want to start off the discussion with sort of a funnel approach in that I want to talk about the companies and sort of strategies they use, and then how the founders are actually synergizing with the next stage of either the life cycle of the company or transacting the company. So David, I want to flip to you and ask you the criteria that you're using when you're trying to figure out if a target company is the right fit or the right metric when going into new markets and new product lines?
It's a great question. So for owners who are thinking about expanding, whether it's new product lines into new regions, either organically or inorganically, really the most important metric is organizational readiness. So is the company able to complete a transaction, but not only complete a transaction, be able to run that business effectively and have it be accretive? And so one of the things that we are constantly talking to our clients about is talk to us about your people, your process, and your technology. Do you have experience in this expansion? Have you been intentional in your growth? How do you think about how to expand? Were you coerced into growing by customers bringing you someplace you didn't used to be? Or were you intentional about it? And so what we try to do with our clients is talk them through where they are today, where they want to get to, and just assess that organizational readiness.
Mm-hmm. And in that discussion, are you finding that they're opening sort of new windows and they're not realizing half of what they should have realized maybe before you even had the chat with them?
Yeah, so many times, business owners are very thoughtful about, hey, I want to do this, I want to grow, but they don't really think about what that means for the organization. Do I have the right people? Do I have the right processes? Do I have the right technology in play? And oftentimes, just by having discussions with advisors, you can surface these issues to help them think through that strategy, but not only think through the strategy, line up the right advisors behind them and prepare to execute a transaction that will work or a growth strategy that'll work.
So David, when you work with those clients, have you found that some of them have already gone through a more rigorous strategic planning process where they have a documented, well laid out strategic plan, or are they just winging it?
Very often, Tony, they're winging it. Is the truth, right? And so bringing a little bit of organization to that thinking can bring them a great deal of value.
How early is too early?
So if you're thinking about growing, right, and within the organization, you've got the ability to, execute that, whether it's the right financing or whether it's the right organizational setup, it does take time to plan for that. So when you want to grow, you do need a strategic plan. You do need the right advisors. It's going to take you 6 months to a year just to figure out how to do that and where to do it.
Right, exactly. I mean, and that leads into the personalities that are behind some of these targets, right? So take the founders, for example. We're looking to maximize really the synergies for that next step in what they do. And so the question becomes, the way you structure that acquisition to maximize those synergies, given the personalities of some of these founders and what sort of they've been doing this for, however many years, they're used to doing it a particular way, and I'll ask you, Rich, how do you work with some of these founders to maximize those strategies or those synergies to make sure that they're in fact, from an operational or technological or customer-driven standpoint, are they doing everything they can without overextending what their own resources that they probably don't have at that point?
Well, that's the thing. You have to look at preserving resources by projecting future cash flow and payback period. I think the people aspect of this tends to get overlooked. Whether you're coming at a transaction from the buy side or the sell side, are the cultures going to mesh? If you're the buyer, do we have an understanding of the seller's culture and how it's going to mesh with ours? Because if the people aren't bought in and on board, it's going to make it that much harder for the transaction to be successful. So when you're the seller, when you're looking to invest resources, if you're a retirement-minded founder, do you have the next generation in place from a C-suite perspective, not necessarily your own family or key employees? Is there a management team in place that's going to allow the transaction to be successful? How are you sharing the proceeds or incentivizing those people that you're bringing in to make the transaction successful? Also, what are you selling? If you're a distributor and you're representing certain manufacturers, oftentimes those contracts, distributorship contracts, are not transferable. The manufacturer has the right to claw it back. So how do you structure future payments that aren't necessarily an earn-out, which can be profitability driven, but you also need to have a component of the earn-out that is revenue driven, that it becomes a factor of the purchase price. Going forward, if it's a younger founder, they want to stay involved. Do you want to put in an earn-out, which is a frequent source of litigation? Or do you want to offer rollover equity where the seller retains an ownership piece in the combined company and gets to participate if the company is sold again at a future date? So I'd say the operational and technological issues are comparatively manageable if you've got the right people in place. But it's you really want to give the buyer an opportunity to succeed in the first year, as long as the people coming over are not negatively impacted.
So for myself, David, maybe you, and certainly you, Rich, we're involved maybe with the clients on a longer term basis, right? So we are able to kind of get up to speed, if you will, or take a little bit more time. But someone like you, Tony, or even you, Mark, that are more episodic maybe in your involvement. So as a fractional CFO, you may be coming in when there's either a plan to try and transact the company, or there's some sort of crisis perhaps that's going on in the company. And then even you, Mark, in the lending piece, they're coming to you when there's a general need, and you're again sort of episodic. How are you finding it's different the way you're dealing with the founders versus us that may be doing it for a longer period of time and have longer runway? Is it more of a cliff function for you, and are they easier, or is it more difficult for them to adapt to the way in which you're trying to adapt for them?
It's a good question, but hopefully and oftentimes we'll be brought in early enough in the process. We talked about the strategic planning process earlier, and David, you talked about whether an organization is operationally ready to do an acquisition strategy. And so, hopefully we can come in and help them if they don't have a written, documented strategic plan, help them, work with the investment banker and the other advisors to really flush that out, and then really determine where they should be investing in infrastructure and people and process, and help them build those teams and systems and put in place that they could they can easily absorb an acquisition with minimum interruption and disruption in their business. And what I found successful, going back to strategic planning, is something as simple as a SWOT analysis, right? Yep. Understanding your strengths and weaknesses. Yep. And what's the purpose of the acquisition? Are you acquiring this company because it brings something that strengthens one of your weaknesses? For instance, I have a really great product and I don't have a distribution channel or in that market, and this client, then this company that I'm buying brings my product to that marketplace, so I'm buying them for their sales and marketing expertise? Or is it a particular company that's leveraging a strength of ours? You know, we may have a strong sales and distribution channel in this market. This is a product that we don't have in our toolkit yet. We're buying this company to strengthen our strength. So something as simple as doing a SWOT analysis is probably one of the most critical things that would help make an acquisition strategy more successful.
It's a great point, because it's a simple tool, but it's overlooked. And that kind of intentionality about what you're trying to accomplish, you know, it's not just the why and the how. I can go buy something, or I can find new customers. Right. It's the core of this. How is this going to help us? Why are we doing this? What hole are we filling? And I think that's a great point.
So Mark and I have done a lot of work in the past with acquisition financing, right? So a lot of this stuff can get addressed early on in diligence, for example, right? So when you're at the bank and you're looking at, you know, you want to bring this to credit at some point, there's got to be some level of diligence you're doing. And I imagine some of this stuff is part of what you guys are thinking about from a kind of a long-term effect at the bank, right?
Yeah. So even though we're technically brought in at the end, you know, I work with a lot of founder-owned businesses, and those founders have never gone through an acquisition before. So they come to me first, and usually the conversation starts with something like, hey, I've been thinking about X, Y, and Z, or acquiring this company. You know, how would you be able to finance that, right? So a very high level, you know, we have a very high level conversation. And then, you know, the next step is, hey, you really need to find somebody like John. You really should talk to an investment banker. You should, you know, figure out the tax implications of this. You know, as you move farther down the road with this company in those discussions, you know, then come back to us with some more specifics. And then as far as due diligence goes, you know, the banks always like a nice SIM put together from an investment banker, because we know that there's been, you know, some significant accounting work and diligence done on behalf of the investment banker and the CPAs and the advisors. As well as a nice quality of earnings report is always great. The banks love those. So we rely on those kind of outside third-party entities to provide us with a lot of information that the financials in and of themselves don't provide.
Absolutely. And one thing you brought up, which is very important, and I'm always trying to listen to this when I'm speaking with, you know, my clients, is who else should be on the team, right? I mean, certainly, you know, I want to be able to try to provide them as much as I can, much value as I can. But if I notice there are spots, for example, they have financial issues, they need CFO help, and they may not have a full-time CFO, right? Certainly from an accounting perspective, right? And then at the investment banking stage, you know, I find a lot of folks are sort of resistant to that at first, but then when they realize the value that can be brought to the table, and just a quick conversation with any one of you actually brings that to light in a lot of respects, and I've noticed that in the past. You guys probably see the same thing.
Yeah, we've all run into companies where the founders and perhaps others in the C-suite understand the product or service real well, but they don't understand their company.
The one thing I would add, John, is I always work, and I know the people on this panel do, is we try to respect the current relationships they have with their existing advisors. There's so much tribal knowledge and legacy and trust they have in those advisors. Yep. So we don't necessarily want to come in there and replace those advisors, but more support them and supplement them with more expertise. And I think that's important for a business owner to understand.
Yeah, absolutely. It's hugely important because they have the institutional knowledge, right? I mean, for us to come in and sort of parachute in and try and deal with that, we don't have the knowledge from day one. So you don't really have to have that difficult discussion of, hey, you know, get rid of Cohan or get rid of somebody and put someone else in there, right? You want, as you say, Tony, keep them around because they can make that runway a lot smoother. And certainly that next transition point can be.
Well, the thing is, like I said, like we take for granted some of the things that we think are common knowledge for everybody.
But they don't know.
But people just don't
I mean,
realize what
business
they
owners are
don't
so
know.
focused on what they're doing right there. They're not, some of them not lifting their heads up, right?
I
I mean, the first thing I say when I form a company for somebody is, what's your exit plan? And they say to me, what the hell are you talking about? Like, yeah, I know.
It's a cliche of working in the business rather than on it.
Exactly. I want to flip to kind of the risk factors. And if we use M&A as a vehicle, as kind of that expansion tool, what's the way to mitigate some of those risks early on? I know, for example, for me, it's, corporate housekeeping, right? Sort of how do we get the suitors to be concentrating on the right stuff, not on the stuff that is just going to distract them, right? So I want to talk a little about that, and then we're going to talk about sort of from what you guys think, if you look at an expansion kind of focused acquisition, what can we do different that might make it more successful post-closing, right? Mm-hmm. So that's a toughie, right? Because now we're talking about integration, which is everybody's nightmare, right? As a matter of fact, you said it in our meeting before. It's like that's a weird way to enjoy what you're doing, right? It's like insane. So, so that is the next half here.
8 times out of 10, things aren't as they don't turn out as well as projected.
They don't go to plan.
You need realistic expectations.
Exactly. And everybody is, thinking, oh, it's going to be great, right? I mean, anybody can say it's going to be great. The problem is, how do you auto-execute if it's not great? What's going to happen? David, I want to ask you, David, some of the biggest risks you see that companies that are really focused on M&A as their expansion, where are the biggest risks, and how do those folks mitigate those risks early and often?
Yeah, so I think it always starts with good planning, right? Without good planning and an understanding of why you're going down this road of inorganic growth, you're going to open yourself up to a litany of potential risks and mistakes. So the more planning you can do, the more you're going to mitigate risk. And that planning includes things like having your financials in order, understanding if financing is behind you or not and what that looks like, having your corporate house in order with respect to your documents and your organization and your shareholder agreements, operating agreements, all these things, as well as understanding any tax implications that might be there from the perspective of this thing that you want to acquire. So listen, there's no end of risk there. I think the key thing for an owner to think about if they're going to grow inorganically is how to systematically de-risk through that entire process.
I don't know about you guys, but I find when I'm counseling a client, not only am I in the situation that they're in, but I'm also looking down the road, right? Trying to see around corners for them. Rich, I can imagine you're doing the same thing. You're coming that day-to-day kind of digging your heels in or rolling your sleeves up, but you still have to have that eye out there because they might not, right?
Right, but when I speak to either a buyer that's doing an acquisition or perhaps a seller that's looking at an earnout that's based on future results, I mean, experience has shown that when you do an acquisition, over the first 2 years, you have to anticipate losing some percentage of the customers or some percentage of the team. How do you plan for that up front? If you're the buyer, you want to make sure that the economics work and recognize that for the transaction to be successful, you'll be making some additional investments after that initial check is written. If you're the seller and there's an earnout involved, what are the minimums and what are the maximums? And can you live with the minimums in terms of feeling that you had a successful exit? Because there are always going to be bumps on the road. There are always going to be hiccups in integration. What is from the acquirer? Do I have an integration team that has experience in doing this? Maybe it's the first time around, bring in some advisors that know how to do an integration. Because otherwise, if you do an integration of a company 300 miles away and you don't send your people in there, that selling company or the acquired company is going to operate the way they always have. So what you have is 2 companies in one name rather than one company with 2 locations.
Yeah, and we're going to talk even more about basically the integration model in a little bit. But I want to go back and concentrate a little bit more on kind of what what those risks again that they're looking at, and how do you mitigate those? So Tony, for example, have you ever gone in with a client and determined, look, I'm looking at what I'm seeing here, you guys just aren't ready yet. You're not ready to go.
Yeah, I think David talked about it earlier. It's all about people, process, and technology, right?
Right.
So do you have the right team together? You know, as companies grow, certain management team are the right people at the right time for that company. So do you have and again, this isn't about replacing people, but do you have the right team in place that can take you from 20 million to 50 million to 100 million? And can you build out the team that's ready to help you once you consume a client to be able to bring that level of expertise? Do you have the infrastructure in place, the people? And that could be from accounting systems and technology and ERP systems, or the right processes in place. Do you have all that put together so that you can mitigate that risk post-acquisition? So thinking through that up front is critical.
Yeah.
It's all about people and process.
And I've noticed, in dealing with lending, for example, they're forced to do that no matter what, right? So they guys have to think about, if either you're doing acquisition financing or working capital, whatever it might be, you guys are, as the bank, are looking at these guys and giving them guardrails, right? That they've got to stay within. So that quarterly reporting or whatever is going on from a monitoring or policing point of view, you're almost forcing them into that. I know there's probably some resistance on that front, but again, I think you've worked, I'm sure, with customers and clients that are in that space that you've got to kind of whip them into shape, if you will.
Yeah, especially with founder-owned businesses who haven't had an acquisition done in the past. Private equity is a little bit different because they understand those guardrails a little bit more than founder-owned businesses. But for us as a lender, there are at least two pretty big things that we worry about. One is the integration risk and that cultural melding, if you will. And Rich said perfectly, do you have one company with two locations, or do you have two companies, who are operating separately? So that's a big factor for us, especially, when the seller may have been the face of sales for that organization for many, many years, and those customers are loyal to that owner, and they can find another product somewhere else that's similar, but they're loyal to that owner because they've been with him for 20 or 30 or 40 years. Right. The other thing that we look at in particular are the proposed add backs to a transaction. So, if EBITDA is X, but it's X plus, 2 million with the add backs, a lender really has to think about what that growth plan looks like. And, how, if there's an earnout, how will the borrower pay that earnout? Is it self-funded through the growth that the earnout is based on, or are those funds coming from cash from the company? And when that earnout hits in year 1 and year 2 and year 3, what are the capabilities, the cash flow of the company to make those payments? So we really worry about integration risk. We worry about earnouts. Where the earnout is on the P&L, right? If it's because that's always a lot of friction between buyer and seller, right? The buyer wants wants it to be on top of the P&L, and the seller wants it to be on the bottom of the P&L. Exactly. So, we look at where that earnout is to kind of help us, and then, if a buyer provides us with projections that both companies have been steady state or have been growing at 4 or 5% a year, and then all of a sudden they're growing at 15% because of synergies. We kind of ask them to roll that back, to a more normal growth trajectory of that 4 or 5%. And then, can the steady state of where they are now on a combined basis handle the cash flow requirements of the debt service?
Yeah, and I view that as, sort of the lending is more immediate, right? They've got to get up to speed, and they've got to sort of get in line pretty quick, because that result of obtaining that money so that they can actually get to that next level is pretty near.
Right.
They got to do that.
Right, and as I said, that a lot of founder-owned businesses who haven't done an acquisition before haven't had those guardrails on, and aren't used to kind of managing that process, managing those bank covenants.
That's interesting, Mark, and you probably see that not as much with some of your existing clients, but I've seen many companies don't realize that the rigors of the financial reporting, when they now have debt and they have to report to a third party, and may have debt covenants that they've never had to comply with in the past. Suddenly, there's a uniqueness to a difference between a privately held owner and operator who's never had to report his financial reports to an outside third party. Now suddenly they've got to be accountable.
We're asking for
to
review
a
level
bank,
financials,
Exactly.
reviewed
or even an
financials
audit,
with
right?
quarterly
Yeah,
debt
yeah.
covenants, and they're like, oh,
Right, exactly.
And they best know it before they get to this point.
Yeah, absolutely.
Because
Right?
by the time you're to that point, you're already up to your neck.
Right.
In,
I mean, I can't run everything through the company from, everything that I possibly
and
own.
your,
all my
and your
personal
brother
stuff.
and your
your
sister
brother
and
your
Uncle
sister.
Frank.
Well,
and,
That's,
yeah.
see, it's interesting. These types of issues, they're recognized and known instinctively by founders who are going to the venture markets and angel markets for financing. They know right away that you need professional management brought in on a full or part-time basis sooner rather than later. But when you're talking about a founder-owned business that was bootstrapped and has become successful, that is now going down this path, the idea of bringing professional management into the C-suite, it's a lot more difficult pill to swallow. Even if it's done willingly, it takes a lot more time to get used to it.
And so just kind of flipping to post-close integration, right? Kind of one of our favorite subjects we all like to talk about, but not quite sure how to execute upon, right? Yeah. So when I'm dealing with an earn-out for a seller, the seller, obviously, they want to achieve that earn-out. The best way that they think they can achieve that is when they're under the buyer's umbrella, they're their own division. They're kind of on their own island, because now they can make those measurements, those metrics are very much secluded, very much are myopic and discrete, and so they can see that. The problem they have, at least from what I've seen, is that they're not being integrated into the company, into the buyer as a whole. So while it might have a short-term effect when they get that earn-out, I think the buyer loses out because they're not being kind of subsumed or integrated into the buyer quick enough. And so, again, they're an island unto themselves. So when I'm advising sellers that are in an earn-out, I say, yeah, that's great. We want to try and have some post-closing control over those metrics. But at the same time, you need to fit in and you need to integrate in such that the greater good, not only for you or for the buyer overall, you're going to stick around. They're actually going to integrate you in.
So that's interesting, John, because I've seen, having sold, been part of a sale to a large global public company and been through their integration process, and also then being part of the buy-side team on that for that group. I've seen it work well both ways. I've seen a successful acquisition where they really left it standalone for a period of time,
yeah,
and kind of didn't drive aggressively into the integration, and then let the business kind of run, and then gradually bring them under their umbrella. But it goes back to what we talked earlier. It's about where are the synergies and where are the strengths and weaknesses. Kind of integrate where you can bring strength, so that you can maximize those opportunities sooner than later. And what you believe is the strength of the company you're buying, kind of leave it alone for a while. And I always, advise buyers to bring a little bit of humility to the process.
Right.
Be humble.
Right.
You bought this company for a reason. Don't assume that everything that you're going to do to that company is the right thing to do. Sometimes it's best just to sit back and listen and learn, because there may be expertise or knowledge from that company you're acquiring that you can actually bring to your organization. So I think humility is an important aspect of part of the integration process.
It's a great point.
Yeah, it really is. And I would say that diligence also. I mean, buyers do enough diligence on sellers. Are sellers doing enough on buyers, right? Can the seller actually integrate in smoothly from a culture perspective, or just kind of an everyday, how does this work? How does their operation work? How does ours work? Is it going to gel? Okay.
Well, I think it's incumbent on any seller that is speaking with a private equity firm to speak to the CEOs or founders of other companies that PE firm has acquired. Did they follow through on their promises, or did you just get the demo version before you signed on, right, so to speak? I think another part of it is that I'm a little bit nervous when I hear the idea about the seller becoming an island unto themselves, especially in an earn-out situation, because more times than I can count, we've seen sellers who might have a good company, a good set of books, but don't necessarily have audited or reviewed financial statements. So they're on a consistent version of accrual accounting, but not necessarily GAAP. If the agreement specifies that the earn-out will be measured on GAAP, and that hasn't been flagged or negotiated prior to close, you can almost guarantee that there's going to be a dispute down the road.
So I know we've talked about this, so the terminology should be a method consistent with past practices, not necessarily gaps. So
Yeah,
that's where so a buyer really needs to have advisors who have been through that before to guide them. Even a simple term like that in an earnout.
Exactly. I mean,
can
look,
have a
you said it
significant-
yourself. We've done it before. We can see around corners
Right.
for these folks, and hopefully they appreciate that. And I think that's the value we really all bring to the table here.
I would also add in one recommendation for the buyer is that while integration is understood in the C-suite and at the investor level, make sure that from the buyer side, your employees understand why you're growing by acquisition. So it's obvious or fairly obvious that the seller's employees need to be presented to and have an understanding as to why they're being acquired. But the buyer's employees need to understand why we're bringing these people in as well. Because otherwise, everything may be copacetic among the two executive teams, but out on the floor, battle lines are going to be drawn if you don't have that discussion with your team prior to close.
Yeah, that's why it goes back to the why, right? And if you've got the why at the beginning because you've planned and you've done the strategy, then you can tell that story. You can tell that to somebody that you're acquiring, you can tell it to your employees,
Exactly.
and then it ties together.
Exactly. So we've come full circle. With that, I think we're going to wrap it up. I want to thank my fellow panelists and roundtable attendees here. Again, if you want further information on any of this stuff, certainly any one of us, I'm sure, can help. We thank you for joining us. See you next time.
Thanks, Jim.
Thank you.
Thanks, Jim. Thanks.
So thank you for watching. Please feel free to follow us on social media. You can like, comment, or subscribe. And please go to our website, gesmer.com.